Good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And we have a very special event here for you this afternoon where we are going to be talking about an algorithm that we have built powered by AI to specifically help you identify trading setups for earnings. We did a session here about a week and a half ago on just the upcoming earnings season, and we briefly touched up on this. But a lot of you came back with more questions around it, and we sent you a email last Friday with the first earnings navigator. So we got a lot of questions about it. So this week we decided that we were going to just dedicate a relatively short but sweet session to just understanding what the earnings navigator is and what the new service is going to provide you with if you are a member here at OptionsPlay.com. Just a reminder, what we do here on these sessions is to empower you to grow your account sustainably and confidently by making sure that you have access to the right tools. Make sure that you have the right tools to help you grow your trading account. And that means that you have access to education that spans a full gamut of what's required to help you grow your trading account, from technical analysis to fundamental analysis to even mindset and psychology, as well as access to the tools that can help you navigate the markets. Those are some of the things we're going to show you during today's session. And then when you look at the tools that we provide, what we're trying to make sure is that we're continuously improving the tools to automate as many steps as possible of the things that we do as part of our process to identify stocks and trade opportunities in the market. What we're trying to do with the earnings navigators we're doing today is we want to show you how we've continuously improve our process to try to bring more ideas and more ideas to your fingertips as part of your membership here at OptionsPlay.com. Now, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during today's session. But my primary goal today is to show you how to identify stocks that have the highest chance of making a big move on earnings. Earnings season is incredibly volatile. It's also a time where there's a lot of opportunity over a very short period of time. So what we're trying to do here is making sure that you have access to the tools that can help you identify the best trading setups on earnings season. So today what we're going to go over is the three-step approach to identifying stocks that will make a big move on earnings, walk you through it step by step, and then show you the earnings navigator, which is our new AI-powered weekly research report with the symbols that have the highest probability of making those big moves for the upcoming earnings week. So for those of you that are asking for whether this session is recorded and that you can have access to the slides, the answer is yes to both. And also just to have access to the tools that I'll be showing you during today's session, you just need to currently have a free trial or a membership here at OptionsPlay.com in order to access all of that. So if you don't currently have access to a free trial or you currently don't have a membership here at OptionsPlay.com, you can sign up on your phone by pointing your phone to that QR code or going to OptionsPlay.com/sign up. It's a free 30-day trial. It doesn't require credit cards. It takes 10 seconds to set up, and it will give you access to the recording, the slides, as well as the earnings navigator that I'm going to show you during today's session. And I'll come back to this here in 1 second at the end for those of you that do want to sign up here for that free trial. So at the core of what we do here at OptionsPlay for earnings is our earnings calendar. And our earnings calendar is built in a way specifically for options traders, because on any given day, especially in the meaty part of earnings season, which is where we are right now, there are typically a few hundred companies that report on a given day. And most earnings calendars sort that list of securities that are reporting on a given day in alphabetical order, which makes it very difficult to figure out who's reporting on that day and which ones are relevant to your trading needs. So what we do is, instead of sorting it by alphabetical order, we sort our earnings calendar based on options liquidity. The more liquid something is, the higher it is on that list. So the goal, sorry, so and if you can see anything that's color coded in green, those are the most liquid symbols that are reporting on a given day for options traders. Anything in yellow are somewhat liquid. So if you've exhausted the list of very liquid symbols, you can go into the somewhat liquid symbols, but I would certainly avoid anything that's not highlighted in color, because those are all the symbols that are not liquid at all for options traders. So if you're trading earnings, especially during this volatile period, you want to make sure that you have the ability to get in and out relatively quickly. So liquidity is paramount when you're trading options around earnings. So our earnings calendar is designed to help you understand what symbols could you trade when earnings season is coming up. So for example, if we're looking at the earnings calendar for today, April 30th. You have Caterpillar, Etsy, and Western Digital that reported in the morning. Those are the three symbols that have the asterisk sign next to it. The asterisk sign denotes a symbol that reports before the market, and anything without the asterisk signs are the ones that are reporting after the close. So you have Robinhood, you have Meta, and Microsoft, Qualcomm. Those are the big ones reporting this afternoon. So, when I'm looking at this earnings calendar, I basically say, I'm thinking to myself, there are four possible opportunities this afternoon that I could potentially trade. And what that does is it simply narrows down my research substantially. Instead of looking at a few hundred different stocks and figuring out which ones I want to research, I know those are the only four that I'm really going to spend some time analyzing. And what I want to walk you through is, how do I analyze those four stocks? What am I looking for? What are the three steps that I need to see before I can decide that I want to take an earnings trade on it? And then from there, that's how I'm going to decide whether or not this is the right trade structure for me. Okay. So let's walk you through how I identify stocks for earnings, meaning how to identify stocks that can potentially make a big move on earnings. And for any of you that have followed me on CNBC for the last few years, whenever I do an earnings play on CNBC, I will always lay out all three items when I'm putting out an earnings trade on CNBC. And those three things are absolute trend, relative strength, and fundamentals. I have to look at all three, and all three have to be satisfied before they are considered a real earnings play for me. And those are the ones that I will trade. And if you ever follow me on CNBC, those are the ones that I will use and identify as a trading setup for earnings. And these are the stocks that have been proven to make big moves on earnings. Now, first thing is absolute trend, which is simply that stocks that are trending in one direction or another. What you want to see are stocks that are moving prior to earnings. And we're really looking for is let's call it the previous week to the previous month going into earnings. Is it heading in one direction or another? And then what you want to do is you want to not only see the stock heading in one direction or another, you want to see relative strength along with that directional move. So if you have a stock that has been trending higher here over the last month going into the earnings announcement, not only do you want to see that stock is moving higher, you want to see that stock as the relative strength is also continuing to improve, meaning it's outperforming the market. And what that shows is accumulation. That's a good sign that institutions are buying that stock faster than they're buying the rest of the market. Or vice versa, if you're looking at a bearish trade where the stock is trending lower, you want to see the stock is not only trending lower, but it's underperforming the market. And that's a sign of distribution, meaning institutions are dumping that stock faster than they're dumping the rest of the market. So that's really kind of what you're looking for in terms of, from a technical setup, from a charting perspective. You want to see both absolute and relative strength or absolute and relative weakness in conjunction with each other. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. And I'll show you a couple of chart setups just so that you clearly understand what I mean from an absolute trend and relative strength perspective. And those two things that we're looking at are based on the technicals or based on the chart of the underlying stock. The third thing we're looking for is really fundamentals. What we're trying, and this is the part that's going to be a little harder to define for some users, depending on whether or not you look at fundamentals and where you get your fundamentals. But largely, the thought process there is you want to find stocks that are at a disconnect with the fundamentals, because the disconnect that you have with the fundamentals is what provides the opportunities for the big move on earnings. If something is trading significantly below its fair value, then earnings is really what can sort of what's the right word? Earnings is what many times can drive that stock to be revalued at its true valuation as new information comes out, and vice versa. If a company is overvalued, it's usually earnings that kind of brings investors back to reality sometimes and forces that stock to re-rate at a lower valuation based on the new information that comes out from earnings. So the larger the disconnect that you have between the current stock's valuation and the fundamentals, that's really where you find some of the best opportunities for big moves on earnings. And we'll go through some examples of that here as well. But a good example of that is, for example, Northrop Grumman. This is an example of a stock that is exhibiting absolute strength, right? So as you can see, it's very clear that the stock is trending higher. But as it trends higher, it's actually also outperforming the S&P 500. You want to see both absolute and relative strength in conjunction with each other to take a bullish setup going into earnings. And then you want to take a stock that's perhaps trending lower and breaking below support and also underperforming the S&P 500 to take a bearish view going into earnings. You generally want to see both aligning with each other before you want to take a directional view going into earnings, because just absolute weakness in itself is not enough. If many times the stock can be trending lower, but just because it's trending lower doesn't mean that it's outperforming the market. Right? So you can have stocks that are trending lower, but it's outperforming the market. That's not a good candidate for a bearish trade for earnings, and vice versa. If you have a stock that's trending higher, but it's trending higher at a rate that's slower than the rest of the market, that's also not a stock that you want to buy going into earnings. So absolute and relative strength or weakness that aligns with each other is number one, the first thing that you're looking for when you're screening for earnings plays. And then once you've identified stocks that have both absolute and relative weakness, and keep in mind, for every stock that you look at, the number of stocks that have both, I apologize. So just to reiterate, absolute and relative strength are the two technical indicators that you're looking at, and then fundamentals is really what you're looking for in terms of the disconnect between where it currently is trading versus sort of what you deem as perhaps is a realistic fair value for that particular stock. So when we're looking at Northrop Grumman, what we're looking for is a stock that's trending higher here, that's breaking above resistance, but at the same time also outperforming the S&P 500. You want to see both in conjunction with each other in order to justify a bullish setup. And for example, in Bristol Myers that's breaking below support, not only do you want to see a stock that's breaking support, you also want to see it underperform the S&P 500. Those two things are really important. And I would say that it's only probably about 20% of the time when you get both, right? Meaning a lot of times what you'll get is absolute strength, but you don't get relative strength alongside with that, or vice versa. If you get absolute weakness, but you're not seeing relative weakness alongside with that as well. I would say only about 20 to 30% of the time are you going to find stocks where both the absolute and relative are aligning with each other. So, what that means is that about 60 to 70% of the stocks that you're looking at, won't fit this particular criteria. So be aware of that. The vast majority of stocks that you look at won't fit this criteria, but the few that do, those are the ones that you want to look further into the fundamentals. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so then this is really where we look at the fundamentals. And this is really where valuation and profitability are probably the two most important things to look at as a starting point. You can look at growth rates, and growth rates matter at the end of the day, but it's definitely one of the things that the valuation and profitability are the two most important metrics that I look at. So for example, if you look at something like Northrop Grumman, that's currently trading at about 19 times forward earnings when the industry average is 28. That means the stock is trading well below the industry average for this particular stock. That's a good sign, number one, for a potential undervalued stock. But it's something that's really only undervalued if it's actually more profitable, in my opinion, than its industry, meaning just because something is trading at a lower valuation doesn't mean it's justified, right? Meaning, I'm sorry, it very well could be justified. So, for example, if a stock is trading at a lower valuation than its industry, maybe it's not as profitable. Maybe it's not growing as fast. Those are all legitimate reasons for why a stock is trading at a lower valuation. So what you really want to make sure is that you see a stock that's trading, at a below average valuation with potentially higher than average profitability, and that's what Northrop Grumman, is currently screening for. So that's an example of a stock that is exhibiting absolute strength, exhibiting relative strength, and fundamentals that are somewhat disconnected from the fair value, right? This is a stock that's more profitable than the industry, yet it trades at a valuation that's substantially lower. That provides a potential for new information to come out and for investors to say, you know what? Maybe this 19 times forward earnings on this particular stock is a little low. This should be trading maybe at 22, 23 times forward earnings with the new information coming out. And that's what causes stocks to jump instantly on earnings. And that's what we're trying to capture, is that instantaneous move on earnings, utilizing perhaps an option strategy to do so. And this is the trading setup that I look for in order to find these particular stocks that have this type of movement. The other way that you can look at this is, stocks that have very high valuation, but either average or below average profitability. A good example of that maybe is Walmart, trading at higher than expected value, higher than average industry valuations, yet net margins that are actually below the industry. Costco is another good example of that. Stocks that are trading at much higher valuations than the industry, even though it's not any more profitable than the rest of the industry. So there are different ways that you can potentially do. You can look at this, but from my perspective, the quick and dirty way is to look at valuation versus net margins, and then if those things all align, you can then look at kind of growth rates. But growth rates, are not the end all be all. Profitability and valuation, in my opinion, are the two most important indicators when you're looking for fundamentals and trying to understand whether a stock is disconnected from reality or not. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so I think the trading setup that I just explained it's really not that difficult to understand, right? However, the one thing that have found it difficult to do is that every single step of what I just explained to you is a pretty manual process, meaning you have to look at the earnings calendar. You then have to pull up the chart for that specific stock, look at the absolute, look at the relative weakness. And like I said, about 70% of the time, at least 70% of the time, you're not going to find alignment between absolute and relative strength. So 70% of the charts that you look at, you end up just throwing away and saying, I got to find the new one, right? And then in that 20, 30% of the time, when you do find stocks where the absolute and relative strength does align, then you do your deep dive fundamentals. And even if you do some quick and dirty, evaluation like I do, that still is going to take you a couple of minutes to understand, what is the industry medians, what are the industry averages, compare the two, get a sense for whether something is disconnected or not, and how disconnected. It's a pretty manual process, and it's something that for years and years and years I did manually. And, to some degree, because it was done manually, it limits the amount of opportunities that I can potentially trade. And sometimes I don't know that I'm always trading the best possible opportunities because I can't possibly look through every single opportunity. So that's why we created the Earnings Navigator. And using the power of AI, this is really the first time that we've been able to completely automate the entire process that I'm showing you. We're able to evaluate a chart. We're able to evaluate the fundamentals using AI. So I've basically built um, uh, models using AI to basically do the analysis for me, do the ranking, doing the scoring, and then showing me only the best possible opportunities, looking at the earnings calendar. So our AI basically pulls fundamentals, pulls technicals, looks at the charts, look at the fundamentals, and only number one, identifies stocks where all three things are aligned. Then it looks at the earnings calendar to check for liquidity, and only when things all match up do things end up on our earnings navigator. And this is something that we're publishing once a week, every single Friday afternoon for the following week. So what you see here on your screen right now is what we published last Friday for this current week. And if you look at today, we have three different stocks that are reporting today that have met all three criteria. We have Meta, we have Microsoft, and we have Qualcomm. Those three stocks are not only significantly undervalued, but they're also stocks with either strong relative strength or improving relative strength and absolute strength here as well. And as you can see, Meta and Qualcomm have pretty sizable expected moves, about 8 to 9%. Microsoft is about 5.5%. And that just gives you a sense for what the options market is implying of what the potential move is on that specific stock. And those are things that you can use to help you figure out, strike prices that you might want to trade on these particular setups. But this is something that we built to fully automate everything that I typically would use on to try to find an earnings opportunity, and doing so in a way that's fully automated, because the old way of doing things was just too manual, and there was no way to really automate it without the use of AI. So now with the use of AI, this is something that we have been able to automate and is emailed out to all of our members on Friday afternoons every single week for the following week's earnings report. So what you're seeing here, which is this week's earnings report, we sent out last Friday afternoon, hopefully giving you a lot of time to do a little bit of extra homework over the weekend to make sure that you agree and you understand how to use this so that you can have these trading setups for the following week. And it's pretty straightforward to understand. It's pretty self-explanatory, and it really is designed to help you quickly identify trading opportunities on stocks that have all three things that I've just talked to you through, and making sure that all three things are aligned before you decide to pull the trigger on a specific stock. So let's just take a look at a couple of stocks. Let's look at Meta, and let's look at Qualcomm real quick. Let's look at Meta, and so Meta is currently trading around 536. It's down 18 bucks today on the back of the GDP print. So things are looking a little weak going into this earnings report. So we do have to factor that into our thought process, into how we think about this. But I do think the stock being down 3.5% here today does actually potentially provide a better opportunity for if you are trying to go long. If Meta does report stronger than expected earnings, the fact that it's down 3.5% might actually increase the move that you see here to the upside. So this is something that I think is important to look at. And generally speaking, when you're trading these, you generally want to use shorter dated options to potentially take that bigger move. So for example, if you're looking at, trading at 536 right now, you might want to look at something around a 50 to 45 delta strike price, maybe something around a 545, 547 and a half, or 547 and a half, for example, as a potential call option to buy. That's currently costing about $2,300 per contract. Not cheap, but it's also a $537 stock. So you have to keep that in mind. We're looking at about 5% of the stock's value that you are risking on this particular trade. And then in looking at, let's say, Microsoft, let's look at Microsoft for a second here. Microsoft is only down about 1% here today, maybe a better candidate for earnings this afternoon. Looking at, let's say, the May 16th expiration, if you're looking at, let's say, a 50 delta, let's call it a 392 and a half run, that's costing you $10.80 on a nearly $400 stock. That's only risking a little over, let's call it 3% of the stock's value. So you're risking quite a bit less here when you're trading Microsoft earnings than you are on Meta earnings. And just look at the overall chart here, right? You have a stock that is kind of just trading against this major resistance level. Is earnings the catalyst that can drive it higher? That's kind of the thought process here, right? When you have these trading setups where the stock is kind of struggling, it's kind of forming this bottom here. It's just trading against that resistance level. It really sometimes needs an earnings catalyst or catalyst to kind of break that out of that breakout here, or break out above that resistance level. And earnings many times could be that catalyst. And then let's look at Qualcomm. Qualcomm, $146 stock here, as you can see. Trading up against this 150 resistance level is earnings. What it needs to kind of get back above those levels here. Let's take a look at maybe looking at a May option that expires in May, which is in about 14 days. If you look at kind of the 147 or 148s, that's costing $5.65 on call it $50 stock. You're looking at a little over 3% of the stock's value that you are risking. So out of these three, I think I probably might trade Qualcomm. Just because, from the expected move, you're expecting about close to a 9% move, yet I'm only risking about 3% of the stock's value to buy this May 148 call option. That's a call option that's only about $2 out of the money. And could potentially give you a nice return if it does make that 9% move to the upside on earnings. It's significantly undervalued, and it's showing both, it's showing both absolute and relative strength here going into that earnings announcement. So this is something that we particularly like here for this particular trading setup, and this is how we identify them. So going forward, if you have either a subscription or a free trial to OptionsPlay, you get access to this earnings navigator, which, like I said, is emailed to you every single Friday afternoon for the next week's earnings announcement. So next week, we'll have another big earnings week. A lot of consumer names coming up. You have Disney, you have Shopify, you have trying to find what else was on the earnings calendar for next week. You've got Disney, you've got Uber, you've got AMD, you've got Shopify, you've got no, that's not Palantir, that's Planet Fitness. So next week is actually, we already have kind of an earnings calendar that's starting to slow down. This week is really the big earnings week. Next week, it's starting to slow down a little bit, but you still have plenty of names reporting next week. The following week, we obviously have fewer, but some big names is there. You have Walmart, you have John Deere, you have Applied Materials, you have Alibaba, you have Cisco. Those are some big names that are reporting, and those are some of the ones that you can see some big moves. You have Cisco, you have Palo Alto Networks. Those are ones that I think could see some big moves, and Walmart as well. So that's really what the earnings navigator is designed to do, is to help you identify which stocks have the highest probability of making a big move on earnings, and helping you identify stocks that all three things are aligned with each other. Now, with that, that is what I wanted to share with you here today. I was trying to make the session short and sweet, not the full hour, but I just wanted to make sure that everyone understood how the earnings navigator works, what you're getting as part of your subscription here at OptionsPlay. So if you want access to the earnings navigator and you don't currently have an account here at OptionsPlay, you can sign up at optionsplay.com/signup, or point your phone to that QR code on your screen. So what I'll do now is I'll open this up for Q&A. There's a Q&A button at the bottom of your screen. Please type your questions into the Q&A window, and I'll try to answer a few questions before I have to sign off. What does the number next to the symbol indicate? So I guess the question is really on the earnings calendar here. The symbol on the next to the earnings calendar is liquidity. 1 is the most liquid options, 2 are somewhat liquid, 3 are not liquid at all. So our earnings calendar is always our earnings calendar is always based on liquidity. The earnings navigator comes to you in an email. So if you have a subscription, we send that to you in an email on to your email address that is registered for your OptionsPlay account. There's a question saying, how do you calculate the expected move? That's a really good question. So if you look at Qualcomm, we'll use a straddle here. What you basically are looking at is the at-the-money straddle. So as you can see, the at-the-money straddle here is around $9.40. So what you do is you take the $9.40, and this is the straddle that expires this week, right? So you take the $9.40, 940, and you divide that by 145. So you get a 6.5% move. So things have changed quite a bit in terms of the expected move here since last Friday. So, last Friday, the expected move was closer to 9%. Now it's only about 6.5% on Qualcomm. But you basically take the cost of the at-the-money straddle, and that's kind of, generally speaking, how you calculate the expected move. Do we use the usual guidelines to trade credit spreads on these stocks? Yes. If you're going to use a credit spread with the stocks on the earnings navigator, then yes, that is you would use the standard credit spread to trade these earnings trades. Do you place the trade before or after the earnings announcement? You can't place the trade after the earnings announcement, because at that point it'd be too late. You got to do it before. So Qualcomm reports this afternoon, so you got to put in your trades now before the market closes at 4 p.m. Do you prefer call or vertical? So, when we identify stocks like this, where we think that there's going to be a big move in one direction, many times I will just use the simple call option, because the call option gives me that unlimited upside potential. The vertical is good for, when you feel that there's not going to be a big move, or let's say it's a really high price stock and you're using a vertical to reduce the total risk on the trade. That's when I'll use a vertical. So if you look at Meta, when it's a $500 stock, you might want to use a vertical there. It just reduces the overall capital outlay you need on the trade. But for Qualcomm, when it's a $145 stock, maybe you might want to just use a call option and get that unlimited upside. Do you buy a week or two in advance, or a day or two? So generally speaking, for earnings plays, a lot of times I'll buy them the day of. So the day, or the day of, or the day before, depending on if it's a morning or afternoon earnings announcement. If it's an afternoon earnings announcement, then usually many times I'll trade it basically right before the close. If it is in the morning, then I'll basically trade it also right before the close for the next day. Yes, we certainly are looking at adding the earnings navigator to the platform as well. But in the short run, what we're doing is we're trying to get this out to you as quickly as possible. We just built the algorithm last week, so we wanted to get it out to you as quickly as possible. And the easiest way to do that at the time was just through the email. But yes, we are trying to bring it onto the platform as well. If the move goes against you, what's your recommendation for setting stops? If the trade goes against you, you really don't need stops. You should just be getting out. You know, if it, there's, I don't think you really need stops at that point. You know, if the trade's not working out, you simply, meaning if the direction of the move is not the intent, was not your expected direction, just get out of the trade. Doesn't matter whether you're down 10% or 30% or 50% or 70%, just get out of the trade. You don't need stops to tell you to get out of the trade. It's only sent out during earnings season. Generally speaking, yes, because we're only targeting the most liquid names on this list, right? So as you get towards the end of the season, you know, you might only have a couple of names and maybe nothing even matches on our list. So it's really probably 6 to 7 weeks out of the earnings season that you're going to get the earnings navigator from us. Would you suggest selling covered put for Microsoft and Qualcomm? If by covered put you mean a short put, that definitely is a potential strategy that you can use, especially if it's a stock that you wouldn't mind owning going into earnings. Yes, short puts is a valid strategy for this for the earnings navigator. Do you suggest buying an outright call option if you're bullish on a stock ahead of earnings? Yeah, generally speaking, a call option is a good strategy for it because, like I said, what we're trying to identify are stocks that are going to make a big move, and call options, you know, allow you to capture that big move fully. Uh, you know, and because you're only holding on to potentially for a couple of days, you know, you're not too worried. You're not too worried about time decay or you know, volatility crush. You're really just in and out of that trade. So call options many times is a good strategy for it. Microsoft goes ex-dividend on 5/15 is a good idea to buy call options expiring on 5/16. Well, generally speaking, you know, this type of strategy, I wouldn't hold to expiration. So in this particular case, I wouldn't worry about that. My goal with something like that, if I bought a call option, would not be hold it to expiration. Bill, if you're a member and you're not getting these earnings emails, please send us an email at info@optionsplay.com and we're happy to look into your account and see why that might be the case. The earnings navigator is not available on the site. It is only available, we're emailing it to all of our members. Do you prefer trading names that report prior to opening or after closing? You know, the big names tend to report after the close. You tend to have a lot more consumer names that tend to report in the mornings. Um, I don't particularly have a preference, but you know, it tends to be a lot of the names that I trade are afternoon reports. How do I access the tool? Which tool are you specifically referring to, if you don't mind clarifying? Bob, your question with regards to Ichimoku clouds, I haven't had a chance to take a look at that. Let's just quickly look at that. It's a little bit off topic, but I'm happy to just at least take a look. Um, you're right. It is just up against resistance. You do have this. Yeah, It's hard to say, right? But my point is that earnings is potentially the catalyst that pierces through the cloud, right? Yes, you're up against the cloud, and that could be, it could find some weakness here, but you could also have just drawn basic support and resistance levels and kind of had the same view, right? That you've got this major resistance level coming through, and that perhaps that's a reason for it to be trading lower here. But what we're seeing here is trends that are improving, as you can see. But not only are trends improving, but it's outperforming the S&P 500 as it does that, and that is really what provides the potential catalyst for this to trade higher going into earnings. And clearly, because it's outperforming the S&P going into earnings, that's a sign that institutions are accumulating this a little bit faster than the rest of the market. So, when you see institutional accumulation going into earnings, that is a sign of some edge, and that's why I particularly use it for earnings. Yes, this webinar will be available via recording. So do you know which way to play these earnings when companies like Tesla miss top and bottom, don't give guidance, but the stock still rallies? You're absolutely right. There's sometimes markets do weird things. Uh, there's nothing you can do about that. There's just nothing you can do about that. You can do all the research in the world and be right, and sometimes markets just move in the opposite direction, and that's just unfortunately something we have to live with as traders in the market. You do not really forecast earnings size or direction. I'm not sure what you mean because the expected move is the size of the expected move, and direction is based on whether a stock is overvalued or undervalued. So we are forecasting both. What indicators do you use to determine relative strength? You're just comparing the stock's returns versus the S&P, right? So if the stock is up 10% and the S&P is up 5%, then you have an outperformance of 5%. So you're looking for how much has the stock moved relative to the S&P 500. Does volatility weigh into your research? Not for the earnings navigator. Volatility goes into our strike selection, everything with regards to the option strategy selection, but not in the earnings navigator. Um, the straddle was, Eva, the straddle for Qualcomm was only to calculate expected move. We're not using the straddle to trade it. We're using a call option to trade Qualcomm. A 50 delta is usually a good starting point for these types of trades. Who's trading after hours? Anyone can trade after hours. Most brokerage firms provide after hours trading. You can trade after hours. You just can't trade options after hours. You can only trade stocks after hours. Um, in Qualcomm, the platform shows that the trends are bearish. Yeah, so a stock can be bearish and can be undervalued, right? And actually, if you think about it, the most undervalued stocks are the most bearish stocks, right? Because how does something get undervalued? It has to sell off. It has to trade lower, right? We all know the concept of buy low, sell high. But how do you actually buy low, sell high? You can only buy low and sell high if you buy stocks that are in a bearish trend. You can only sell high on stocks that are in a bullish trend. So it is counterintuitive, but that is, I would say, a lot of investing and trading is a bit counterintuitive. A lot of times you think, oh, I should only buy stocks that are already in a bullish trend. But by definition, if a stock's already in a bullish trend, then you're sort of late to the game, right? You're basically buying high and hoping the stock goes higher instead of really buying low, selling high. So yeah, it does it sounds a little bit a counter or sorry, it is counterintuitive, but like I said, a lot of investing is sort of counterintuitive. Um, How would you suggest a setup to a trading structure for undervalued, mildly stock? Yeah, great question. So, for those mildly undervalued stocks, I think probably something along the lines of a credit spread is probably a better strategy for those types of stocks where you're expecting the stock to make a relatively small move, or a debit spread that's kind of straddling the current price of the stock is another way that you can do it. So, for example, if you look at Microsoft here, let me just adjust this to the May expiration for a second. If you look at something like where a debit spread where you're doing an equal, the stock's at 390. So let's say you do a 385, 395 debit spread. This type of spread, that might be something that you might want to use if it's more mildly undervalued as opposed to something that's significantly undervalued. Do you suggest roles for additional profits? Absolutely. If you feel that, especially on something where, something was significantly undervalued and now the stock has kind of come back to a more fair value and you think there's more room to go, that's really where you could roll that and continue to look for further upside. Yeah, last Friday was the first time we sent out the earnings navigator. So the next one you're going to get it again is this Friday. Yeah, the earnings navigator right now is not on the platform. It is only available by email to all of our members. Yeah, and even in the email that we send you with the earnings navigator, we suggest an option strategy for this for these stocks. Last week we suggested, a short dated, out of the money call option as a starting point for a lot of these stocks. If the expected move is 8%, could also go down by 8%. Yeah, that's exactly what 8% expected move is that it can move 8% higher or 8% lower, meaning 68% of the time, it's going to be within 8% higher or 8% lower. That's what the expected move is meant to tell you. Is your preference for call options for Qualcomm May 9th or May 16th? Yeah, I would say either one is okay. It really is more of a personal preference. I probably would do the May 16th because those are the monthly options. Those are just generally speaking, sorry, I take that back. A lot of times the weekly options have dollar strikes and the monthly options have $2.50 strikes or $5 strikes, right? So a lot of times I do prefer trading the weekly options because you just have more choices in terms of strike prices. So just to be clear, the earnings navigator does not have a view on every earnings. What it only does is identifies when stocks have all three criteria that I laid out during the beginning of the session. Only if a stock meets all three criteria does it make it onto the earnings navigator. If something has absolute strength but doesn't have relative strength and isn't significantly overvalued or undervalued, it's just not in our report. And from my perspective, it's not worth trading. So I would say the vast majority of the stocks the earnings navigator doesn't have a view on. It's only the stocks where all three things are aligned does it tell you, does it make it onto the earnings navigator. Okay. Unfortunately, that's all the time that I have to answer questions. I hope that this session really helps you better understand what the earnings navigator is, and I hope that you guys see value in it. And please let us know if there are any questions that you have further on this tool, because we're very excited about it. I have been trading these types of strategies for years and years and years, but I've been searching for these strategies manually. So I'm really excited that I now have an automated process using AI to be able to identify these top performing opportunities for earnings season. And I'm, for one, very excited to be trading some of these. And I'm glad that you guys now have access to all of them as well here at members here at OptionsPlay.com. And I just want to, again, thank you for those of you that are members and supporting us and allowing us to continue to do this day in and day out. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.